ಅಂತ ಗೊತ್ತಾಗುತ್ತೆ.
ಓಕೆ, ಅದು ಫೋಟೋ ಹೊಡ್ಕೋಬೇಕು ಅಷ್ಟೇ.
ಇಲ್ಲೇ ಇದು ಪ್ರಿಂಟ್ ಸ್ಕ್ರೀನ್ ಮಾಡ್ಬಿಡಿ ಅಷ್ಟೇ.
ಕೇಳಿಸುತ್ತೆ. ಓಕೆ. ಸ್ಲೈಡ್ ನೆಕ್ಸ್ಟ್. ಬಾಗಿಲು ಎಳ್ಕೊಂಬಿಡಿ. Good afternoon to all. Myself, Professor C. Madhemurthy, Professor and Coordinator, MBA Coordinator, Department of Studies and Research in Management, Karnataka State Open University, Mukta Gangotri, Mysore. My subject is Accounting for Managers. Yes, here, introduction to accounting. Introduction to accounting. During the 12th century, accounting has become essential to the need of our society. Almost every person and organization uses accounting information to make decisions. Many times we use accounting concepts and procedures without even realizing it. Individuals maintain bank accounts, account for their incomes, and file income tax returns. A small business need accounting information to determine if it is financially successful. A large companies must keep detailed accounting records to report financial results to the shareholders and others. Government uses accounting procedures to plan and control the receipts and expenditures of public funds. In fact, the list of accounting users and application is practically endless. The concept accounting has often been called the language of business. The language of business, because accounting terms accounting has been often called the language of business because accounting terms and concepts are used to describe the events that make up the existence of business. As you gain a knowledge of accounting, you also increase yourness or conducted. Like other languages, accounting is also a man-made art. Changes and improvement are continuously being made in it. Definition of accounting. Here, of the various definitions of accounting, one of the most accepted definition is that given by American Institute of Certified Public Accounts, that is AICPA, committee given as under. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of a financial character and interpreting the result thereof. This is the definition given by American Institute of Certified Public Accounts. Yes, before that, This definition reveals the following characteristics of accounting. The first one is accounting is an art which help us in attaining the objectives of, that is ascertain the financial result. That's the first concept. The second concept, accounting, recording, classifying and summarizing. In accounting, business transactions are recorded according to their nature. These transactions are then classified by opening accounts in the form of a ledger. Lastly, the all recorded and classified information is summarized in the form of trading, profit and loss account and balance sheet. Then third concept, accounting results transactions, accounting records transaction in terms of money. If for example, if 9 tons of sugar cane is purchased for 90,000, which will recorded in accounts and not 9 tons of, that is sugar cane. Fourthly, only transaction and events of financial nature are recorded. The meaning of this, if a transaction or an event has been financial character, it can be expressed in terms of money. All the business transaction that is measured and expressed in terms of money, and therefore it will not be recorded. Lastly, interpreting the results of accounts. Here, accounting information may be interpreted with the help of certain techniques like ratio analysis, and other techniques will be discussed later. This is the meaning of 5 important meanings. The first one is, that is accounting is an art. That is the first concept of, that is definition. The second concept is accounting, recording, classifying and summarizing. That is the second concept of accounting. Their definitions of ACP definition concept. The third one, accounting records transaction in terms of money. Then fourth one, only transaction events of financial nature are recorded. That is the fourth concept. Then last concept is interpreting the result of accounts. This is the 5 important concept that is included, that is defined by the AICPA accounting, that is the American Institute of Certified Public Accounts. The next one, difference between bookkeeping and accounting. The difference, that is usually a question generally arises in the minds of the students. What is the difference between bookkeeping and accounting? What is the difference between bookkeeping? What is the meaning of bookkeeping? What is the difference? And accounting. Bookkeeping means, what is that bookkeeping? Bookkeeping is concerned with techniques of recording the transactions. It is a technique of recording the business transactions and summarizing the recorded data. Secondly, summarizing the recorded data and presenting the financial statement. Thirdly, presenting the financial statement, that is in the form of trading account, profit and loss account and balance sheet. Yes, in other words, what is the meaning of bookkeeping? Bookkeeping is an art as well as science. Art means recording systematically, then art recording the transactions. Then science, it is systematically, procedures are there. We need to follow the procedures. Scientific methods are there. We need to use that. We need to adapt that scientific method. Therefore, bookkeeping, we call it as an art as well as science of recording business transactions and of an individual, of a firm, of a company, of a corporation and other association of persons and institutions in a certain set of, that is books regularly. maintenance of books is concerned, that is every year, regularly we need to maintain the books of accounts according to prescribed rules and regulations. Therefore, that is an art systematically we recorded, and as well as science, that is prescribed rules and regulations, systems, rules and regulation. That is, we call it as an bookkeeping. Bookkeeping includes journal, ledger, and trial balance. Later we will discuss about that. What is the meaning of journal, what is the meaning of ledger, and what is the meaning of trial balance. I hope those who are from, that is BCom and BBM, then they know that what is the meaning of, that is journal, ledger, and the trial balances. Those who are from non-commerce and management students, we need to understand that. Yes, here, what is the next concept? That is accounting. Next concept is accounting. What is the meaning of that accounting? Accounting is a wider term. That is a wider term, and it includes bookkeeping. Accounting includes bookkeeping. Therefore, we call it as that is a wide term. In addition to bookkeeping, the accounting is also concerned with analysis and interpretation. That is most important. Bookkeeping, we systematically we record as per the rules and regulations of the accounting. That is bookkeeping. Because here in accounting, analysis and interpretation of the financial data, financial information, we analyze and interpreting the data. Therefore, accounting is a wider term. We call it as a wider term. That is the meaning of that. Then this is also clear from the definition of accounting given above. In short, accounting is distinguished from bookkeeping primarily by its analytical and interpretive functions. Functions is concerned, that is entirely, that is differ from bookkeeping and accounting. This is the meaning of accounting. Yes, the next one is purpose of accounting. What is the why? What is the purpose of accounting of all the business organization? It may be individual, it may be partnership organization, it may be joint in the family, or it may be company, or it may be corporations, or it may be other forms of business organization. They are we call it as different forms of business organization. What is the purpose of maintaining or that is preparation of books of accounting? Here, the basic purpose of business accounting is to supply meaningful information about the financial activity. The purpose is to give the meaningful information about the financial informations. Yes, meaningful information of a business. Those who have we have a need for a right to have such information. That is, the accounting is of a business to those who have a need for a right to have such information. This information needed by those who have a that is legitimate interest in the financial position of a business enterprises. This includes business manager to help them plan and control the business activity. The purpose is to planning of the available resources in the organization, and that is controlling is most important. In management, planning and controls are most important. In that context, this is accounting. The purpose of accounting is most important to maintain, to utilize the available resources effectively and efficiently, to plan and control the business activities. This is the meaning purpose of the accounting. Here, business manager to help the plan and control the business organization. That is the first concept of the purpose of accounting. The second concept, outsiders. Who are the outsiders? The outsiders, they want to know the financial position of the organization. They want to know the financial position. Why? The outsiders want to know the financial position of the organization. It may be a owners. The owners, we call it as a creditor, that is owners, those who are contributed capital in the form of equity shares, in the form of preference shares, and in the form of loans and advances. We call it as the owners. and creditors, they call it as an loans and advances. Those who banks or other financial institutions, they provide the financial in the form of loans, we call it as a creditors, and other, that is persons, we call it as an that creditors. Then investors and the public who have to supply money to the business. Therefore, this is the second most important purpose of the accounting is outsiders want to know the financial position of the organization. What is the financial position? What is it if the company making a profit or loss? If the business making a profit or loss, that is most important. The purpose of investment itself, we call it as to make a profit. In that context, the outsiders is also want to know the financial position of the organization. That is also one of the important purpose of the accounting. And thirdly, yes, these are two important concepts of purpose of accounting. The next one, accounting principles. Accounting principles, the concepts, rules and conventions of accounting are commonly referred as principles. Accounting concepts or rules and conventions of accounting are commonly referred to as its principles. Accounting principles are described by terms like concepts and conventions. Terms of concepts and conventions. Yes, here the terms concept is used to mean necessary accounting assumptions upon which accounting is based on, whereas the terms convention is used to signify customs or traditions as a guide to preparation of accounting statement. Accounting in simple, that is, we call it as an accounting concept, that is an assumptions upon accounting assumptions. On the basis of that, we are some concept with our rules and regulations. Assumptions and rules and regulation, we call it as an accounting concept. Then conventions means that is in customs or tradition. Our accounting stalwarts, accounting experts, they are practicing some customs and traditions. That is also, we call it as an accounting convention. This is the pillars of accounting. Accounting concepts and convention pillars. Most important concepts or accounting concepts and conventions are most important for in accounting to preparation of books of accounts. Yes, accounting concepts. Under that accounting concepts, we have, that is almost 9 accounting concepts are there. One is business entity concept. Second one is, that is account going concern concept. Third one is cost concept. Fourth one is dual aspect concept. That is, fifth one is money measurement concept. Sixth one is, that is accounting period concept. Seventh one is accrual concept. Eighth one is matching concept. Ninth one is objective evidence concept. These are all the most important concept in the accounting concepts. Here, what do you understand by the business entity concept? Business entity, the word itself says that business entity. What do you mean by that? Business entity means what? Each and every word having its own meaning. Entity means what? Entity means separate legal entity. Separate legal entity. There, the business is distinct from the person who owns it. Separate entity, legal entity. For example, Reliance, you take an example, Reliance. Mukesh Ambani invested money on Reliance company. Who is the owner of the Reliance company? Mukesh Ambani is the owner of the Reliance company. He invested. Mukesh Ambani invested money on Reliance company because here the company name, each and every separate business entity concept means each and every business should register. Legally should register. Companies Act of 1956 and New Companies Act of 2013. Each and every business should register separately. Legal entity, seal is there. Separate seal and separate legally should be registered. That is separate from his owner. You take an example in business entity concept. For example, Mukesh Ambani invested 10,000 rupees on Reliance company. If we withdraw 2,000 rupees from that Reliance company, what is the journal entry? What is the entry for that? That entry we call it as an drawings. Whatever the money withdraw from that business, Mukesh Ambani withdraw 2,000 rupees from out of his 10,000. If he withdraw 2,000 rupees from his business, that accounting transaction we call it as an drawings. Drawings. Why it is that transaction is drawings? Because he invested. Mukesh Ambani himself invested, but invested money on business, but if we withdraw money from that, that is we call it as that transaction we call it as that is drawings. Because of this business entity concept, each and every business having its own separate entity from its owner. That is the meaning of that. Sole trading concern, we need to register name of in the name of X company, Y company, Z company. On the basis of this business entity concept, each and every business separate from his owner. Owner means contributors, capital contributors, separate from his capital contributors. He contributed in the form of assets and liabilities. He owns it, but separate from his owner. Books of accounts in the name of Reliance company, not in the name of Mukesh Ambani or Tata, whatever it may be. On the basis of this concept, this is a rule. Each and every business should follow that business entity concept, separate from his owner. Separate seal is there, separate name is there, books of accounts maintained separately. Whatever the money, if he money withdraw from this business, that is we treated as a drawings on the basis of this concept. Next one, going concern concept. What do you mean by going concern? Each and every business, each and every concept having its own meaning. Here, going concern concept means the life of the business is indefinite. Is assumed that business will continue for a long time. We don't know. We don't know the life of the business. It may be 1 year, it may be 10 years, it may be 5 years, it may be 100 years, or it may be 50 years. On the basis of this concept, business going concern. Going concern means business is always that is going concern. We are not going to fix that. On the basis of its efficiency, ability, and PLC. I hope you that is studied in PLC, product life cycle. Because all the products is not possible to process all the stages of the product life cycle. How is it possible? Any product for that matter, any goods and services is matter for that matter. Only few products, only few companies, only few business. There is having its own long that is history because of their efficiency, ability, then other factors. Other factors, going concern. The life of the business is indefinite. It may be because it depending upon the efficiency, then capability, then dedications, employee dedications, owner dedications, and everyone. Contribution is most important. That is in the base of this concept, second concept, that is going concern concept. That is business is always going long term. That is the concept of that. Then third one, cost concept. What do you mean by that cost concept? All the business transactions will be recorded at cost in the books of accounts. At cost. It means deducted depreciation from the asset, yearly assets, market price and cost price. On the basis of this concept, market, you take an example, real estate, building, or any that is assets and live assets. Market price is entirely different. That is cost prices, it may differs. In that context, that is depreciation. We charge appreciation and depreciation in books of accounts. And the base of this concept, that is most important. Because if you use machinery, what happened? The life of the machinery is deteriorated. The life of the machinery, because that is lesser and lesser. Maybe the life of the machinery is 10 years. Every year we need to charge that. Why we are going for depreciation? Why we are going to charge the depreciation for every year for particular that is machinery or furniture? Because we need to replace that. It is the duty of the organization to replace the life of the machinery or a furniture. It may be 5 years or it may be 10 years or it may be first year 15 years. After that, we need to replace that. Where we need to replace that? We need money to replace that. Therefore, we charge. That is a non-financial transaction. The depreciation, we call it as a non-financial transactions. Every year we need to charge on the basis of the cost concept. Market price, then cost price, each and every, that is assets, that is we recorded in cost, and we charge appreciation and depreciation of that on the basis of this concept. Then next one is, fourth one is dual aspect concept. Dual aspect. Dual means, what do you understand by that? What is the meaning of dual aspect? Dual aspect means each transaction is twofold effects. Each and every, because therefore, I will explain in detail. Next slides, I will explain that. Debit, two aspects. Each and every transactions of accounting transaction, that is twofold effects, two effects. One is debit, another one is credit. Twofold effects. There are three principles of that. I will explain in later, because in that is dual aspects mean twofold effects. Debit aspect, that is effect, and credit aspects. It may be personal account or real account or nominal account. Personal account information, that is debit in personal account, debit the receiver. Then second effect, there's a next effect is credit the giver. In real account, debit what comes in, credit what goes out. In nominal account, debit all expenses and losses, credit all income. Twofold effects. All the transactions. Therefore, in trial balance, while preparing trial balance, I will explain in detail. This is all the concepts, accounting concepts are rules, we need to follow that. If we are not follow that, the accounting, that is CH, or accountant or ICWA persons will not approve that, not accept it. Accounting standard will not accept it. Therefore, each and every transaction, that is double entry system of bookkeeping. And the base of the double entry system of bookkeeping is nothing but dual aspect concept, twofold effects. Each and every transaction, that should be twofold effects. Either it may be trading account, or it may be profit and loss account, or it may be profit and loss appropriation account, or it may be balance sheet. That is twofold effects on the base of this concept. Then fifth one is money measurement concept. Money measurement. Each and every transactions, that is should be recorded in monetary aspects only, measured in terms of money. Take an example. I took an example. What is that? 9,000 tons of sugar cane purchased for 10,000 rupees. 9,000 tons. That is in quantity. What is the cost of that? The cost is, that is 10,000 rupees. We recorded in books of accounts, that is 10,000 rupees. That sugar cane, the cost of the sugar cane is 10,000 rupees. That is the meaning of that. Here, money measurement, all the business transaction, that is should be recorded in monetary aspects only. We should not record transactions in kilograms, quintals, meters, liters, etc. We are not going to mention that. Tons, we are not going to tons. Yes, 9,000 tons, we are not going to mention that, because we mentioned 9,000 tons of sugar canes of rupees 10,000. Only money transactions, not barter system. We are in, that is monetary transactions. That is the meaning of all the business transactions, that is measured in terms of money. Measured in terms of money. Yes. Sixth one, accounting period concept. Accounting period means, we know that the life of the business is indefinite. On the basis of the going concern concept, we don't know. We can't measure 1 year or 2 years or 5 years or 10 years. We are not going to predict that. It is impossible to predict that, the period of the life of the business. Therefore, the accounting AICPA suggested that the most important concept is accounting period concept. Accounting period concept means measuring the profit or incomes and or expenses of a period only to be considered. Usually the period is 12 months. Accounting period is 12 months. Accounting period concept, we don't know. As per the second accounting concept, that is going concern concept, the life of the business is indefinite, we can't predict. On the basis of that, accounting period concept, that period concept tells about the period, specific period. It is a period of 12 months. It commences 1st April, ends with 31st March. Then, or it may be, it commences 1st January, ends with 31st December. Or in cooperative and other sectors, it may be June 1st or July 31st. Whatever it may be, because these are all the accounting period. It is a period of 12 months. It commences 1st April and ends with 31st March. It is a period of 12 months. That is, we call it as an accounting period concept. Then one typical question arises here. For example, newly started business. In the month of October, the newly started business started. What is the period of? Because as per the accounting period concept, the period of 12 months. The period should be 12 months. Newly started business. What is the accounting period? Yes, it commences 1st October and ends with November. That is right or wrong? Then it commences 1st April, ends with as per the accounting ending period. That is correct. Maybe it commences 1st October and ends with 31st March. If he uses 1st April to 31st March. If the accounting practices, that is ends with 31st December, it commences 1st October and ends with 31st March. This is the accounting period concept. Then next one is accrual concept. What do you mean by accrual concept? Then in accounting, we considered accrual concept means we considered the amount earned but not earned in this particular year. Accrual concept. Amount rent received, rent earned but not received. That is also that is considered in books of accounting. Rent earned, or that is interest earned but not received at the time of closing of the books of accounts. On the basis of this accrual concept, that is also be considered in books accounting concept. That is accrual concept. Rent earned or interest earned or income earned, not yet received. Next year we are going to receive. That is also we consider in books of accounts. Therefore, that is also on the basis of this conceptual concept we consider that. The next one, matching concept. Matching concept means that is the meaning of matching concept. That is expenses incurred for a period or match with the revenue for a same period to arrive as a that is reasonably correct measurement of the net income or the net loss. Here, match. What is the two important concept we considered in books of accounts? One is revenue, another one is that is expenses. Incomes and expenditure are receipts and payments. That's all. In accounting, we considered in receipts and payments account, what are all the receipts we received from that from the business of in that business organization? What are all the expenditure we incurred in that business organization? We recorded in the receipts and payments account. In the books of accounts, what are all the expenses and what are all the incomes we earned and we incurred? That is the two important concept. That is matching concept. That should be expenses should be matched with incomes. That is most important. That is on the basis of this matching concept. Then lastly, objective evidence concept. I hope you have experienced that. Majority of them you have experienced that here. Objective evidence concept in accounting, auditing. I hope you have heard that the word of auditing. Many of them are experienced. Many of them are working in auditing process, involved in auditing process. All accounting transactions should be evidenced and supported by object or documents. Documents are most important here. For example, purchase of raw materials rupees 1 lakh. The voucher is most important. Invoice is most important. Without that invoice, auditor, chartered accountant, or auditor will not accept the transactions. Yeah, evidence are most important. Objective evidence are most important. Each and every transaction should be supported. Documents is most important. Auditor will not accept. Chartered accountant will not accept blindly. If you have any transaction, there should be evidenced. Document evidence is most important. Otherwise, auditor will not accept, chartered accountant will not approve that books of accounts. This is the objective evidence concept. Evidence are most important for all the business transactions. These are all most important. These are all the rules. Each and every accounting practitioner should use this while preparing books of accounts. First one is business entity concept, going concern concept, cost concept, dual aspect concept, money measurement concept, accounting period concept, objective evidence concept, matching concept, then accrual concept, matching concept, and objective evidence concept. These are all the accounting concepts. The next one, accounting conventions. What do you mean by that? Accounting conventions. We already discussed about that. These are tradition. Accounting conventions are traditions and customs. Customs and traditions. Your accounting stalwarts, accounting experts, they are practicing many traditions and customs. That is also we are practicing in accounting. For example, while preparing books of accounts, trading account, profit and loss account, trading account, left hand side, we recorded, we mentioned DR, debtor, right hand side, CR, creditor. Because this is in accounting, this is not an accounting rule, but our accounting stalwarts, they are practicing. That is also, still we are practicing. That is also most important. Therefore, rules and regulation and customs and traditions, that is also most important. For both, while preparing books of account, these two are accounting concepts or rules and regulations are most important, and accounting conventions also most important for while preparing books of accounts. Here, accounting conventions are conventions of conservatism, conventions of disclosure, convention of consistency, convention of materiality. These are all the customs and traditions. Still, we are practicing. What do you mean by that convention of disclosure? The word itself says that disclosure. Disclosure is most important. Each and every books of accounts should be disclosed. Therefore, because you log on to any company's website, you have seen books of accounts. Why? Because that is belongs to the company information, but it is mandatory disclosure as per the Companies Act 2013 and 1956. Important convention of convention of conservatism, disclosure. Sorry, convention of first one is second one is I am explaining. Convention of disclosure means that is account should be prepared in such a way that all material information is clearly disclosed to the users. Many parties, they are interested to know the financial position of the organization. Disclosure. In that context, disclose all the books of accounts, whatever the information that is needed. Here, owners are, because if you take an example in the form of company, the owners scattered in different places throughout the globe, they are scattered. It is not possible to come and see and verify the books of accounts in the company or an organization, joint stock company. In that context, if the company disclose all the documents related, business related documents, they can see the owners, then public, because why publics are interested? The purpose of the each and every production or each and every activity to welfare of the society, they go for that productions, welfare of the society. Each and every right, public have right to ask the price, the quantity, the quality. In that context, the public is also interested to know the financial position of the organization. The next, government. Why government want to know that? To levy taxes. Each and every transaction, the government levy taxes. Therefore, government is also the want to know the financial position of the organization. Therefore, disclosing all the accounting information in website or what any form of that is any form the business organization, the company or any organization that is disclosed, that is convention of disclosure that should be disclosed. Then next one is convention of that is conservatism. Conservatism means any business while recording the transaction should anticipate no profit but provide all possible losses. Conservatism to protect the organization. You take an example. How to conservatism? Reserves and surplus. I hope you heard that. The words of reserves and surpluses. Why the organization create reserves and surplus? The purpose of creating reserves and surplus. Bad debts reserves. Because if you go for credit sales, bad debts arises. That is common in nature. Credit sales. That is credit sales is also most important. Majority of the organization they go for credit sales. More than 90% of the sales are credit sales. In that context, debtors are arises. On the basis of convention of conservatism, protect the organization. In what way we need to protect the business organization? To create reserves, provisions, depreciation provisions, other provisions. If anything may happen, fire or theft or anything, we need to protect the organization, business organization. Therefore, we need to create reserves and provision. That is convention of to protect the organization. That is the traditions and practices. This is the second one. Then third one, convention of consistency. Convention of consistency means that is an accounting method or procedure once chosen should be followed consistently from year to year. The best example of this, the best example of convention of consistency, depreciations. How many types of depreciation we have seen? There are different 5 to 6, more than 6 types of depreciations are there. Each depreciation having its own significance. Diminishing balance method, then annuity method, then other methods, annuity method, diminishing balance method, straight line method. There are different types of depreciation out there. Each depreciation method having its own significance. Therefore, if the organization uses annuity method or diminishing balance method or any other types of simple that is depreciation method, any type of method, if every year should follow the same method of depreciation accounting procedures. Not only depreciation, other procedure is also. In rationalization, there n number of techniques are there. If you adapt the techniques for a particular year, some extent we need to follow that. That is on the basis of the convention of consistency. We need to use the consistency some extent. We need to use that consistency on the basis of these accounting conventions. Then convention of materiality. Convention of materiality means only those events should be recorded which have significant bearing and insignificant things should be ignored. Here, which is more important? Who will decide that? Which is the most important aspects of the books of accounts or the business organization? The manager. Because I am a marketing manager, I know that which is most important in marketing activity. Then advertising, which is most important. It is because expertise. Important is because to gain the profit, these are all the concepts are most important. Therefore, which is most important, left to that is the responsible persons, accounting persons or finance persons or marketing person, because our advertising person or sales person or purchase person, each and every person having its own significance, having its own expertise, materiality, which is most important, which is not important, because while purchasing, that is raw material. FIFO method, we are using FIFO method, we are using LIFO method. On the basis of the expertise. Price is the most important concept of that. We are using FIFO method or LIFO method. Price is most important here. Raw material price is most important. If the raw material prices is increases, which method we are going to use that? Materiality is most important. Therefore, the responsible person uses which transaction, which activities is more important on the situational basis. Situation basis is on the basis of that he will took the decisions. Here there is no formula for identifying the material and material event or immaterial event. It depends on the that is accountant directions. Expertise directions is most important here. Which transaction, which activities is most important for that is business activity in that context, that is materiality. It left to the expertise. These are the most important concept, that is conventions. That is convention of conservatism, protecting the organization, then disclosure, the organization to disclose each and every aspects that is related to books of accounts or disclose in website or any other form. Then convention of consistency, using the methods, accounting methods consistently, the organization, the accounting practitioners should use that. Then materiality, which is most important, the expertise will take the decisions. This is the most important accounting conventions. Yes, the next one is the difference between accounting and that is management accounting and management accounting. What is the difference here? The financial accounting, the purpose of financial accounting is to communication of financial position. Accounting is to financial accounting, the purpose is to communication of financial position. In case of management accounting, for decision making, the purpose is to take the appropriate decisions. This is the purpose, first difference. Then second one is primary audience, that is in case of that requirement is concerned in accounting, financial accounting, that is mandatory, that is most important. But in case of management accounting, optional. It depending upon the organization, it depending upon the that is different forms of organization. That is it depends on that. Here mandatory and optional. Then primary audience, external. In accounting, books of accounting, many parties are interested to know the books of accounts, investors, regulators, tax authorities, etc., public, etc. They are the primary audience. In case of management accounting, management, internal people, only internal people to take the appropriate decisions. That is most important. Then only we can achieve the goals of the organization. Organization will achieve the goals of the organization. Then regulation or guidelines, GAAP, generally accepted accounting principles. That is the rules. GAAP, we need to follow that GAAP, generally accepted accounting principles. IFRS, International Financial Reporting Standards. Then IAS, Indian Accounting Standards. That is the rules and regulation we need to follow while preparing books of accounts. GAAP, generally accepted accounting principles, we need to follow that. IFRS, International Financial Reporting Standards, we need to follow that, rules and regulations. Then Indian Accounting Standards, rules and regulations, we need to follow that. But in case of management accounting, no such hard and fast rules, no such. Then frequency is concerned, that is books of accounts, it may be quarterly, it depending upon the organization, then annually or a period, it depending upon the organization or significance of the books of accounts, they go for that is frequency. Because in case of management accounting, as needed and ongoing, it depending upon the that is significance, it depending upon the uniqueness, they go for that. The external reviewer is concerned, auditor and regulators, because in case of certified copies are most important for, therefore we call it as an internal auditor and external auditor. Internal auditor, then external auditor has to certify that. CH, chartered accountant, has to certify all the books of account, that is auditors and regulators. Then in case of management accounting, no such. Then focus is concerned that the past transactions. Accounting is nothing but post-mortem transactions. Post-mortem, past transaction or post-mortem transactions. In case of management accounting, information to aid, that is decisions for the future management decisions, information on the base of the accounting information, management accounting information, we plan for future period. That is the focus. Then purpose, that is scope is concerned, that is company wide. Then narrow, is it because a wide accounting is a wide concept, because in case of management accounting, that is an so that is narrow concept. It depending upon the each and every aspects of the business organizations. Then accounting equation. Ah, the proprietor provide fund for a acquisition of assets. Hence, the asset owned by the business must be equal to fund provided by the proprietor, which means technically called equation. What is that equation? Because here, proprietor or the owner or investor invested money, investment money, fund, provide fund or invested money for acquisition of assets. Acquisition of assets. Hence, assets owned by the business must be equal to fund provided. That is most important. That should be that is matching concept. All the whatever the fund provided invested in that business organization, so it would be equal must be equal to fund provided by the proprietor. Yes, there is this which technically called equation. That equation, assets is equal to capital plus liability. Capital, liability side, capital plus liability, assets is equal to capital, that is plus owner's capital plus liability, we call it as an, that is put together, that is we call it as an assets. Then capital is equal to assets minus liability. Assets minus liability is equal to, this is an equation. Then vice versa, liability is equal to assets minus capital. These are all the accounting equations. The next one, already that is spoke on this accounting rules, that is personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. These are the accounting rules. Then accounting cycle. What do you mean by that accounting cycle? Here, recording monetary transaction in a systematic manner, that is accounting. First, we need to while preparing books of accounts, the accountant or those who prepare books of accounts, that is recording monetary transactions in systematic manner. Then secondly, generalize journal entries, that then pass the journal entries. Then third one, that is prepare books of account, that is ledger. Then after that, trial balance, debit and credit, particular trial balance, we need to prepare that. Then after that, with the help of the trial balance, we can prepare trading and profit and loss account and appropriation account and balance sheet. This is the cycle. First transactions, then journal, come into force in journal. Then after that journal, we go for, that is ledger or separate account. Then that separate account, after that we go for trial balance. Then with the help of the trial balance, we prepare trading account, profit and loss account and balance sheet, and appropriation, pay and appropriation account, and lastly balance sheet. This is the accounting cycle. Recording. Recording of transaction. First one, recording of transaction is done in journal or subsidiary books. Commence business with each cash rupees 50,000 and machinery rupees 10,000. These are journal transactions. What is the journal entry? We are going to pass that. That is cash account debtor. Here is 50,000. Machinery account debtor, that is 10,000. Then capital account, because capital, that is commence business with, that is commence business. That is capital of rupees 60,000 in the form of machinery, that is in the form of cash 50,000, in the form of machinery, that is 10,000. Put together capital, that is owner's capital, that is 60,000. This is the journal entry of this. The format of journal, that is a serial number, date, particulars, ledger folio, debit and credit. This is the concept of journal. Then ledger classification. set of accounts to be taken place during the period of time called ledger. Here, ledger divided into two portions, left hand side and right hand side. Left hand side we call it as a debit side, right hand side we call it as a credit side. Date, particulars, JF, LF. Ledger folio, debit balances, date, then next side, credit side, date, particulars, ledger folio, credits, then credit side. This is the format of ledger. Then same transactions, commence business with cash rupees 50,000 and machinery rupees 10,000. How to pass that? Here we need to open and separate account, that is cash account. Here that is by balance, that is cash to capital 50,000, then 50,000 cash in the form of cash 50,000 that is contributed, that is no other transaction in cash, that is by balance carried down 50,000, total is 50,000, both the side, debit side and credit side. Then machinery account we need to open, and machinery account separate account we need to open here. Then to capital 10,000, no other transaction, that is also by balance carried down 10,000, both debit and credit balances are 10,000. Then we need to open a capital account, that is by cash account 10,000 in the form of 10,000 he contributed cash. Yeah, no, sorry. That is vice versa. Cash is 50,000. Cash is 50,000 and machinery is 10,000. Yes, cash is 50,000, machinery 10,000. That is balance is no other transaction, that is 60,000. Balance is, that is 60,000. This is the way of preparation of ledgers. Then summarizing business transactions, that is presenting the classified data which is understandable and use the internal as well as external end users of financial statements, that is format of trial balance, serial number, particular. Ledger folio means what you understand by ledger folio? That is page number we recorded in ledger folio. Debit balances we debit balances, credit means credit balances. This is trial balance. Here same transactions in serial number 1, particular, cash 50,000 debit balance, then machinery 10,000 debit balance, then capital, that is credit balance 60,000. This is the format of trial balance. Then preparation of final accounts of sole proprietorship. Here financial statement is prepared yearly or off yearly depending upon the organization. This statement will prepare to know the profit and loss account of a company or a business, and also to know the assets and liability position of a company. Then preparation of final accounts including 4 types of accounts are as follows. That is, one is trading account, another is profit and loss account, the next one is profit and loss appropriation account, and last the balance sheet. These are all the preparation of final accounts of sole proprietorship and other business forms of business organizations. Okay, we will continue tomorrow. Thank you very much for your listening, patience, isn't listening. How many of them are participated? Number is not displayed here. Okay, thank you very much.